I think you should be allowed to.
All right. So we had a big debate, V-shaped, W-shaped, U-shaped, L-shaped recovery. I'm aspirationally V-shaped, but I'm expecting a U. Sacks, you were the L, and I think, Chamath, you were the W, the U or the L. We've had a V. How do you explain, Chamath, what is going on in the stock market? Because you said it was the end of days. You said this is going to be a disaster. Is it going to be a disaster? Is this the end of the days and we've got some false rebound and this V-shaped recovery is not sustainable? How do you explain this inexplainable V-shaped response? Yeah.
There's two things to keep in mind. First of all, the economy is completely fucked. So don't look at Facebook, Apple, Amazon, Microsoft, Google, and a handful of internet SaaS companies and kid yourself. We have 30 million American men and women out of work. That is, every fifth person you see walking down the street does not have a job.
What happens when lockdown ends? If the lockdown ends in June, as expected for most people, how many people rebound?
So look, here's the thing that we've had. We've had trillions of dollars of money printed into the system. And when you print that money into the system, which the Federal Reserve has done, it hits the asset markets and it has basically stabilized the bond market. And the incremental dollar sits in the hands of an individual who must put the money to work. Because when you look back on this is not, a random person managing their 401k. The overwhelming majority of the money sits in the hands of hedge funds or pension funds or sovereign wealth funds or mutual funds. They have a job to do. And so you have to think about what is their incremental decision. So even if the stock market made no sense on any valuation metric, the incremental dollar that they have, which they're paid to put to work, will get put to work. And so what you've actually seen is a dispersion. And what I mean by that is if you graph the S&P 500 index versus the unweighted S&P 500 index, which basically means the first one ranks companies by market cap and gives the biggest companies more weight. The other one ranks every company equally. There's been a massive split, a dispersion. And what it really shows is that companies that traffic in bits, so software businesses, have a bid, and companies that traffic in atoms have gotten completely decimated, and they are literally worthless. And so when you put all these things together, the real economy is in the toilet. There are tens of millions of men and women out of work. The earnings power of real companies that do physical things in the world are cheaper and lower than they've ever been. Meanwhile, the companies that have high velocity, high margin, software driven businesses have gone to the moon. So it's unfair to look at 30 or 40 businesses and paint that as a V-shaped recovery. It is a equity market that is buoyed by Fed dollars that is not mapping to the reality of what's happening on the ground.
Okay, so Sacks, you're pretty plugged into the economy and you think about this a lot. What do you think the recovery looks like? Is this going to be 2, 3, 4, 5 quarter recession? Is it going to be depression era, like some people are apt to say? What keeps you up at night thinking about the economy, and what gives you hope?
Well, it kind of depends if there are other shoes to drop. So I agree with Chamath that the state of the economy right now is terrible, and it's divorced from the financial markets because of all the money printing and interventions that the Fed and Treasury are have been doing. One way to think about it is, well, the stock market's denominated in U.S. dollars, and if they just printed a whole bunch more of them, those dollars are worth less, and so the price of the stocks are going to rise. But yeah, I think looking forward, it's probably going to be a 2 to 3 year process to get out of this, unless some other shoe drops, which could make it much worse.
So you're betting on 2 to 3 years to get back to, let's call it, single digit unemployment.
Well, let's see, we're at 15% right now or something like that. So
35 million people, you get down to 10 million again, 20 million.
Yeah, I mean, it's hard to say. It's going to take a long time to create all those jobs. A lot of these businesses are not just going to come racing right back. So yeah, I think it's probably like a 2 to 3 year process to get back to some sort of,
And by the way, the thing you have to remember is like, look, the unemployment numbers that we have had in the last probably 7 or 8 years, so during Obama and Trump, have been completely manipulated because the number of people that are entirely leaving the workforce is quite high. And so, it's not just a numerator problem. We have a denominator problem too. There are fewer and fewer workers that, are willing to work because some of them just give up.
Right. Or it's just not worth it for the pay that's available is another stated reason.
So the thing that we're going to have to figure out is like how many of the people that are leaving the workforce may never come back. And that has a societal toll and weight that we all have to bear.
Yeah, there's going to be a lot of people who maybe are in their 60s or maybe even late 50s. They got 10, 20 years left that they could be working in management, sales, whatever it is. And they just say, you know what? It's not worth it. I'm going to go try to find a place to stay and maybe not rejoin the workforce. Early retirement or just capitulation.
Yeah.
Well, but remember what I said about other shoes dropping. I mean, we're still in the early. I think we're still in the early stages, seeing the repercussions of what a 2 or 3 month shutdown of the economy. What that's going to look like, and so the wave of defaults is just beginning, and who knows what happens with cities and states, and so on down the line. I mean, who knows? Do the debt markets have kind of an inexhaustible desire to buy U.S. debt, or could we reach some sort of saturation point, and then that triggers the next set of crises. So we just don't. I would say like the 2 to 3 year outlook is the one that's kind of like what it looks like today. But if there are these other big shoes to drop, it could